What do you do when the facts change? From gun legislation to a presidential election to monetary policy. It may be time to take a fresh look. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on whether the Fed is finally on its way to seizing the initiative on inflation.
I still think that the Fed and most market participants are underestimating the gravity of our situation.
And Stephen Bird of Aberdeen on where an active investor turns when everything seems to be going down.
You should recognize that throughout your investing life, there's always the cycle.
This was a week for taking stock. When Republicans and Democrats in Congress moved toward a compromise on gun legislation that wasn't what either wanted, but leaders like Jim Clyburn of South Carolina concluded was so much better than nothing at all.
I'm a half-loaf sort of guy. A half loaf is better than no loaf at all.
A week when House Select Committee hearings made it clear that some of President Trump's top aides, like his Attorney General Bill Barr, struggled in vain to get him to accept the fact that he had lost the 2020 election.
And I was somewhat demoralized because I thought, boy, if he really believes this stuff, he has, lost contact with he's become detached from reality.
And most of all, it was a week for central banks to come to terms with just how far behind inflation they had fallen, as recognized by former Bank of England Governor Mark Carney.
I think what's clear is central bankers need to catch up to their economies.
And the ECB tried to catch up with the European economy by telling its staff to get on the job.
The ECB called an emergency meeting, and that caught everybody's attention. The takeaway, a call for staff to accelerate work on a new tool to combat unwarranted jumps in euro area bond yields. While the Bank of England hiked rates once again.
The Bank of England's never done more than 25. Don't forget, it was unprecedented for it to do 5 hikes in a row.
And Fed Chair Jay Powell stepped up to the podium to announce the biggest rate hike in over 20 years, with the promise of much more to come.
75 basis points today. I said the next meeting could well be about a decision between 50 and 75.
And if you wondered whether the markets were listening, just take a look at the results from this week. In a wild week of trading, and actually an update for stocks on Friday, overall for the week, the S&P 500 closed the lowest it's been since December of 2020, losing almost 5.8% for the week overall, while the Nasdaq wasn't too far behind, down by some 4.8%, while ironically, bonds didn't fare so badly, considering the Fed news, with the yield on the 10-year up just 7 basis points, ending the week at 3.23%. Here to take us through what really was an historic week in the markets are Bob Diamond, founder and CEO of Atlas Merchant Capital, and Joanne Feeney, partner at Advisors Capital Management. So, Joanne, let me start with you. I'm not sure it's fair to ask what the markets made of this week because they were all over the place. There was so much noise in the marketplace. But what did you take away from the week?
Well, David, I think clearly the market is coming to terms with the higher risk of recession, with the reality of higher interest rates for a bit longer than perhaps they had expected. And that's doing a couple things. Higher uncertainty means stock valuations have to come down with that higher risk premium. And with higher interest rates, on the coming now and on the horizon for a bit longer than expected, that also takes valuations down. So we saw in the price action a clear move towards safety. Consumer staples outperform, healthcare outperform, and banks, are a mixed bag because they're benefiting from those higher rates while at the same time they could face headwinds from a recession.
So, Bob, you're Mr. Banking. What did the banks make out of this?
Well, I think the banks have a very, very interesting period ahead. On the positive side, David, as Joanne said, higher interest rates in this kind of an environment, steeper curves, more volatility, higher rates, across the board are good for banks. They're good for their margins and lending. They're good for a host of things, their repo books. But the thing that'll be most positive, I think, when we see the earnings is it's an incredible trading environment. Those banks, particularly the U.S. banks that maintained a trading platform, are going to have a really, really strong quarter. On the more balanced side, I'd say that unquestionably we have a serious commitment to investing in our opportunistic credit fund. We're seeing real cracks in the lower end of credit. And I think the banks are going to face not just, a weaker economy, but one of the aspects of that will be higher provisions in their credit books. And that comes after a couple of years of either modest or credit write-backs. So on the positive side, rates will be good. Trading is going to be extraordinary. On the more balanced side, mortgages down quite a bit, writing of mortgages and credit provisions.
So, Bob, the markets did a lot of adjusting this week, a lot of capital reallocation, I think is fair to say. Did they do enough? You heard Larry Summers there in the open saying he thinks the markets still don't understand how much pain we have in front of us. Do you agree with that, Bob?
Yes and no. I mean, I think you have to give some credit. We've talked about this since last December. The Fed waited clearly too long. They eased with zero interest rates and $120 billion in U.S. Treasury and mortgage security purchases into an economy that had already recovered, had tight labor, had higher prices and higher inflation. So we're paying that price now. But having said that, I thought that the chairman was correct and the Fed was correct to raise 75 basis points this week. We are starting to see the early signs of economic downturn in manufacturing and consumer sales. Very, very early days. So I don't think this is adequate. But I do want to give some credit for the recognition that they have to move more quickly. My worry, though, David and Joanne, I'd love your perspective on this. My worry is that in other cycles, we've seen the Fed tighten when the economy is doing really well. As they continue to tighten here, which they need to do, they'll be doing it into an economy that's beginning to slow. And I worry that that could be more impactful in terms of the slowing of the economy.
So, Joanne, what about on the equity side? There's been a lot of devaluation, if I can put it that way, a lot of cheaper equities today than there was a month ago. Is it time to start buying equities again?
Well, yeah, David, clearly we are in a slowing environment, as Bob just pointed out. But what people forget is that earnings are nominal. This inflation that we're seeing is showing up in companies' sales figures. It's showing up in their earnings figures. And that's why earnings expectations keep ratcheting higher, even as valuations come down. And what we're seeing is a lot of good company stocks being thrown out, being pummeled along with weaker company stocks. And that does create opportunities for investors to go sort of quality hunting, particularly if you're a GARP investor, a growth at a reasonable price. There's a lot of good companies out there that have become very attractive here. And investors really need to focus not on what's going to happen for 6 months or even 12 months. If you're in the equity market, you better be there for multiple years. And this right now does create a really good opportunity to enhance your portfolio and build for beyond the current crisis.
Bob, it strikes me that one of the things we heard this week, out of President Biden, as well as out of Fed Chair Jay Powell, is we're not in this alone. When it comes to inflation, and by the way, tightening in a lot of places, it's more of a global phenomenon. You have a lot of experience with investing around the globe. What does this tell you in terms of investing around the globe?
Well, I think number one, when you look to Europe, it's at times like this that, it gives us great confidence here in the U.S. that the depth and quality of the capital markets are second to none in the world. And as Joanne said, as you go through a period where it's kind of risk off, so everything is declining. And we had exuberance in not just stocks, we had exuberance in house prices, we had exuberance in Bitcoin, and everything is kind of risk off. Thank goodness that we have this incredible capital market in the U.S. And you compare and contrast that to the challenges in Europe, with 26 odd countries, without a banking union, with less flexibility around fiscal integration, less flexibility around monetary policy, and nowhere near the depth and quality of the capital markets. I think the challenges that we face are going to be faced in greater sense across Europe.
Bob, fair enough, very deep capital markets, but we saw some real problems with liquidity toward the beginning of the year, particularly in the 2-year Treasury. Are we concerned at all that the markets might actually break?
I don't see that as a concern at all, no. And I think, again, you look to the diversification, depth, so much of what's here in the U.S. in terms of the capital markets is a huge advantage. And to worry about the depth of the U.S. Treasury market around the 2-year is just not something that should be on our list.
And you can see that from the strength of the dollar as well,
Yeah.
right? I mean, there's a reason why investors are still flocking to treasuries. And it's because, we're still a safe haven. There's still more confidence in the U.S. government's ability to pay its debts than, almost any other. And Europe, by the way, obviously is facing greater headwinds than the U.S. is. So if you're going to compare stock market opportunities, given the war in Ukraine and the sanctions and the energy problems, makes the U.S. look far more attractive.
Well, Joanne, I'm glad you took us to FX because that's a question. Can the dollar continue to strengthen against the other currencies like that? We saw the Swiss National Bank, for example, surprise everyone, at least surprise me, on raising rates, and we may have the ECB close behind. Is there going to be sort of a currency tension there?
Yeah, that's going to be really hard to predict. I think it just depends on the pace of the tightening in the multiple countries, right, to determine those relative prices of currencies. And right, what we're seeing is this global inflation problem is really born of all of these shortages that started in the pandemic, that extended to OPEC's constraints on supply, and then, of course, from the war. And so, we're all trying to get inflation under control. And that the currency movements, I think, are really just signifying how important the dollar is and U.S. Treasuries are as a safe haven in this kind of an environment.
Bob,
just to feed on that, it's both the technicals, which is, the depth of the capital markets and the liquidity of the dollar and, what's the alternative, as well as the fundamentals in terms of, how the Fed is behaving and whatnot. So it's really both the technicals and the fundamentals, Joanne, that I think are favoring the dollar right now.
Okay, Joanne Feeney and Bob Dunn are going to be staying with us as we turn to what an investor can do in this turbulent market and how much faith in the end we can put in the consumer. That's coming up next on Wall Street Week on Bloomberg.
The Dow Jones Industrial Average, which hit its 1971 low a week ago Tuesday, has been moving up every day since then. That index of 30 old line blue chip stocks has added more than 60 points in the last 7 sessions, 43 of them this week alone, and barreled ahead to close today at 859.59.
That was Louis Rukeyser at the end of 1971, over 50 years ago now, when the market was on its way back. And the way we measured it was by some version of the Dow. What a difference 50 years makes. This week, the stock market was doing anything but moving up. And we were talking about the NASDAQ and the S&P 500 more than we were the Dow. Still with us are Joanne Feeney of Advisors Capital Management and Bob Diamond of Atlas Merchant Capital. So, Bob, let's talk about those markets and how they reacted. We had some predictions out of the Fed that really said inflation is going to go down under their projections without inflation, without unemployment going too high. Were those realistic?
They're not really predictions. I think what it is, it's a survey of all the Fed presidents. So it's kind of the numbers that come in. But David, I think what struck me is in order to get inflation down, 50%, which is what they're looking at, to think that we're going to have virtually no change in unemployment or no pain in some other area just seems realistic. And whether or not we can get core inflation down at those levels very much depends on further action by the Fed. So is it possible? Sure, I think it's possible. I think it's unlikely that it will happen without a bigger impact on the broader economy and unemployment.
Let me jump in here. The Fed is trying to operate this solution through 2 mechanisms. And a lot of people focus just on one of those. The idea being raise interest rates, reduce overall economic activity, which means companies then don't hire as many people. In fact, they fire people, and that slows things down. And that's sort of, that's one way to do it. You reduce the income of households, then they can spend less, and then inflation falls. But the other mechanism is higher interest rates themselves, right, have an impact on financial conditions affecting both households and firms. And households basically say higher interest rates means it's going to cost me more to finance a car, it's going to cost me more to buy furniture, it's going to cost me more to buy a house. Firms are saying it's going to cost them more to do any projects they want to do. But it's the consumer side. If those higher interest rates actually induce consumers, right, to do less of those big purchases, that is the other mechanism, that substitution effect, getting them to wait for a year or 2 years to buy those things when supply might come back. because it ultimately will hurt the Fed's objective if they reduce overall economic activity too much, because we do need more stuff to be produced also to keep inflation moving in that downward direction.
So, Joanne, that really begs the question of the consumer and the consumer's balance sheet, because there's something like 2.7, I've seen, $trillion still sitting in the balance sheet of a lot of households. And maybe they'll just sit on that as savings, or maybe they'll keep spending it, which will make it more difficult for the Fed to get inflation headed down sooner rather than later.
Yeah, that's exactly the other challenge that the Fed faces, is consumers are flush. They've paid off a lot of their debt. They're sitting on a lot of savings. But generally, households, that's a measure of household wealth. And generally, when households spend, they don't ramp up spending because their overall wealth went up. They tend to spread that over time. And in times of uncertainty, they tend to spend less of that. They're going to try to make it last longer. So in this period of time, when people now might start getting worried about what the future holds, whether they're going to keep those jobs that they got, whether new job opportunities might disappear, we may very well get a situation where consumers decide, you know what, we better keep those savings in the bank and spend less, and hoping that prices will come down for cars, as they've begun to do, and for other things.
Bob, what about the prices coming down for stocks and for bonds? At what point do you become a buyer of bonds? You've been, obviously, most people have been a seller recently. At what point do they become enough of a bargain it makes sense? And stocks, for that matter, the same thing.
Well, I think in the government bond market, we talked last year that we needed to get interest rates higher. We talked about that. The range of the 10-year has been 1.5% to 3%, virtually for over a decade. It got slightly below that during COVID, but basically when we talked in December and January, it was like at 1.5%. It's now above 3%. So, in some ways you can make an argument that there's real value in the 10-year. My own view, David, is that in order to impact inflation or core inflation at 5%, we're going to have to continue to drive the overnight funds rate closer to 4 to 5%. And what the markets are discounting right now is 3% at the end of this year, maybe 3.5% to 4% at the middle of 2023. I think it's going to get closer to 4 to 5% over time. So I do think the 10-year will go higher. But certainly there's a lot of value in a 10-year, as you show right there, at 3.17% versus what it was just not so long ago at 1.5%.
So, Joanne, what about that on the equity side? If Bob is right, and by the way, he's not alone in saying we got to get to 4 or 5%. If that's right, does that say it's not time to be buying stocks, or are there some shopping opportunities right now?
Yeah, I think it's a good time to be very selective about holding on to various stocks. The Fed clearly has a short-term problem ahead of it. Short-term being, a few years, not 10 years. And if you look at the long-term forecast that the market holds for inflation out to that horizon, it's still only about 2.4%. So inflation expectations are pretty well anchored, and that should help keep the 10-year from going up too much further, but I wouldn't rule out certainly something in the order of 4%. That's going to make it more challenging for growth stocks, there's no question. But companies that have more resilient growth sources, like those providing parts for cloud computing expansion, for data center expansion, these are the types of areas that tend to power through recessions. Companies like a Broadcom or a Cisco are really well positioned for this kind of an environment. And I think investors could find in those, which have come down substantially, real opportunities for solid returns over the longer term.
Bob, you mentioned credit earlier as maybe presenting some opportunities as the spreads really increase. But at what point, if you're really going to 4 or 5, do you have to be worried about defaults? I mean, is credit too risky at this point?
It's spot on. I mean, I think, as you know, David, we started a opportunistic credit fund 2 years ago, and we're already seeing the crack. And I think having dry powder and having an opportunity to invest across the capital structure in good companies who have had maybe a bad financing structure or just don't have access to financing or are being hurt by higher interest rates, there are going to be some fantastic opportunities for investors who can opportunistically look at opportunities for good companies with a poor financing structure. And I think we're already beginning to see those opportunities emerge.
So, Joanne, I'm going to give you last word here. Given what Bob just said, does that argue that you need to be more in cash or cash equivalents right now? Because he said there's going to be opportunities. You need the cash to invest. Are you more in cash than you have been in the past?
No, we're not. We think it's pretty challenging to try to time a market like this. And so being in cash is implicitly a bet against a recovery, at some point in time. It's just very hard to get that right. So our view is investors should be positioned based on their time horizon. If they need cash in the short term, they better not be too exposed to equities. If you're in equities, you really should be looking to the 2-year, 3-year, 4-year, 5-year horizon. And so we don't think it's a good time. In fact, as Bob was saying, we think there are actually opportunities now. Those opportunities may very well get better. We don't know, but there are certainly opportunities now. And a lot of times what investors, our clients, will look for is income from those investments. That helps them ride out these tough times. And you can find a lot of good dividend yielding stocks, some in the growth world where they have those long-term drivers already in place, and some in the safer spaces like in the financials, which will provide some protection against those rising interest rates.
Yeah, well, protection is the relevant word, I think, for this week, without a doubt. As I say, it was an historic week in the markets. And thank you so much, the two of you, for helping us sort through a really tumultuous time. That's Bob Diamond of Atlas Merchant Capital, and also Joanne Feeney of Advisors Capital Management. Thanks so much for being with us. Coming up, we're going to take a look at what's coming up next week on Global Wall Street. That's next on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. It is time to look ahead to next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. Chinese lenders are likely to keep prime rates steady in the week ahead after a decision by the PBOC not to trim its key rate. Stronger than expected activity in May suggests the worst of the Omicron setback is over, and policymakers are wary that lower interest rates could spur damaging capital outflows given the Fed's rapid tightening. Meanwhile, reports from Japan, Malaysia and here in Singapore expected to show inflation continues to climb across Asia. Now over to Lizzie Burden in London. Lizzie?
Thanks, Juliet. In the coming week, all ears will be tuned to the various ECB speeches, including from President Christine Lagarde and Chief Economist Philip Lane, for hints as to what the bank's new tool to curb market stress is going to be. We'll also get the latest inflation data out of the UK. CPI is expected to edge up in May, driven by rising food and fuel prices, though economists don't expect price growth to tip into double digits just yet. On Thursday, we also get a bank rate decision from Norges Bank, and the question is whether it follows the global trend and surprises with a half-point hike to rein in inflation that's at a 30-year high. Now to Romain Bostick in New York.
Thanks, Lizzie. U.S. markets will be closed Monday for the Juneteenth holiday observance. But when investors return from the break, they will have their eyes on Fed Chair Jerome Powell. He's scheduled to appear before the Senate on Wednesday and the House on Thursday, potentially providing additional insight into the Fed's efforts to curb inflation. Economic data in the week ahead include home sales, S&P manufacturing PMIs, and the latest revisions to the University of Michigan consumer sentiment numbers. Earnings to watch include FedEx, Accenture, Darden Restaurants, Carnival Corp, and home builder Lennar. And keep an eye on two pieces of antitrust legislation in Congress that would force large technology companies like Amazon, Apple, and Meta to open up their product platforms to smaller rivals. The House lawmaker leading that effort said both bills could pass a vote as soon as next week. David?
Thanks to Juliet Sally, Lizzie Burden, and Romain Bostick. Coming up, we've weathered downturns before, but never when this much of the market was invested passively. What's the active playbook for what we're going through? We hear from Stephen Bird, CEO of Aberdeen. This is Wall Street Week on Bloomberg. The downturn is here. It's been a long time coming, but the Fed put is over, as Christina Hooper of Invesco recognizes.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
And investors like Mark Lazary think that means a recession is just around the corner.
Everybody knows we're either getting into a recession or it's going to be close to a recession. I don't think there's a lot more negative news that's going to come out.
We've had recessions before, but never when passive investing played so large a role in the market.
Certainly, households really haven't seen a significant acceleration in their ownership of equities, nor a deceleration. They've just kind of ridden the wave and slowly added more to passive and away from active over the course of the last several years.
And Kathy Wood of ARK thinks the shift to passive investment will go down in history as what she calls a massive misallocation of capital. But whether it was wise or not, former CBO head Douglas Holtz-Eakin says that the move to passive has undermined the ability of the market to reallocate capital at the time we need it most.
I think one of the most important things the stock market does, from an economist's point of view, is price discovery. How do you identify promising new uses for assets when you're coming out of a downturn? How do you repurpose capital in the economy? And that's going to lean against what all the passive investors are doing. If no one's out there doing price discovery, no one's out there doing the risk-taking that leads to reallocating capital, the stock market's a less efficient entity.
Stephen Bird runs one of the leading global active management firms, and he is CEO of Aberdeen. We welcome him now to Wall Street Week. Stephen, thank you so much for joining us. We do have a downturn. I think we can all agree on that right now. And a lot of investors are saying, where do I go in a downturn? What does active management offer you that perhaps passive does not?
Well, it offers you a lot. There's no doubt that there is a place for passive and has been a huge place for passive. But when you had 15 years of super easy money and all boats rising, then you can run a momentum cycle. And many, many people did. And that was a large part of the driving growth of passive. Now, when the cycle has reversed and the tide's going out, and as we can see today, we have the NASDAQ so far this year down 30%. We're in a bear cycle. In a bear cycle, you want to be very selective. You want to be able to make decisions to be defensive. Essentially, you don't want to own everything, and passive is owning everything. So there is our role as an active investor is to be able to answer the question of where should I go, what should I do next, how can I preserve my capital and be in a position to grow capital when there is a more conducive environment.
So, Stephen, help some of our investors right now on that very question. As you're seeing growth subdued and some concerns about even recession here in the United States as well as elsewhere, and at the same time you see inflation really, if not out of control, looking in that direction, where are places you can go that's different? Where can you zig when others are zagging?
Yeah, well, the very important thing to recognize for every investor, and it's where we begin, is that you should be diversified. It's the first step to ensuring that you're actually never going to have massive concentration risks. So you should be diversified. And you should recognize that throughout your investing life, there's always the cycle. Now, there have been 14 bear cycles since 1929, and those bear cycles, on average, last 20 months. So what you've got to think about is, yes, right now you're seeing inflation, very, very hot, and you're seeing central banks all across the world, the Fed yesterday with 75 bips, and overnight the Swiss as well, everybody raising, tightening the cycle to tackle inflation. So what should you do? Well, you want to be in a defensive position. You think about equity with strong income, long-term quality, defensible business models with the ability to price through in higher input costs. You also got to think about, if you think more on a more macro level, which countries are going to be accommodating whilst the US in particular and Central Western Europe and the UK are tightening. China is actually a counter to that. China was struggling whilst the US was thriving, and China is actually going to be accommodating whilst the US is tightening. So in a diversified portfolio, which is very important, you can think of those places as being able to have a better prospect of growth whilst there is such an effort to reduce demand, which is clearly what's going to have to happen. It's beginning to happen, and it is going to happen in the developed economies.
So let's pursue that just a little bit, China specifically. I think I understand at sort of a macro level, 40,000 feet, that China is probably going to be loosening at the same time the United States and a lot of other places are going to be tightening. I understand it macro. At the same time, China is a big country and a big economy. You have to be pretty careful, don't you, about where you invest in China?
You absolutely have to be, and you really have to have people on the ground. So we do have and have had for the last 30 years. So understanding the cycle, we're very, very selective in terms of where we would invest. And again, that's about, you've got to peel the onion and figure out which businesses can thrive. Well, businesses that are able to supply and service consumer demand in China, of course, are some of those businesses, because they're going to have high exogenous demand. Those are some of the businesses that you would want to be in. You wouldn't want to be in right now in real estate. Of course, those issues are well known. There are areas of tech where you do want to be invested in China. China actually is producing a lot of clean tech for the energy transition. And the energy transition, as we know, if you think about, yes, today we're very preoccupied by inflation, very preoccupied, and the media is full of, a tightening cycle. But climate change hasn't gone away. I think for the balance of our careers, the energy transition is one of the single biggest opportunities. It's a risk for the planet, it's a risk for individual businesses, and it's one of the biggest investment opportunities that we will face. So being able to identify within that energy transition which technologies, which clean technologies, if you think about solar, if you think about wind, if you think about tidal, but if you also think about sustainability of food supply, if you think about energy management systems and software systems, those are areas that we know that when you look through this cycle will have high demand. And we're investing in those. Of course, sustainability lies at the very core of what we as a business are doing. And it's not a marketing thing. It's about risk management. It's understanding the true environmental, social, and governance risks associated with any particular investment.
Stephen, one more on China, if I could. There's political risk in any investment anywhere in the world, but certainly there is in China. We've seen some, for example, investors in high tech and sort of the big tech over in China really get burned over the last year or so. How do you take into account political risk when you do pick your spots in China?
It's incredibly important to understand that in China, politics drives policy, policy drives progress. So you need to understand these episodes of reform. In fact, as you know, I've spent the bulk of my career living and working in the Far East, living and working across these different investment categories, and I have seen many episodes of reform where Beijing allows the capitalism with communist characteristics to grow and thrive, and then it resets because it sees inequities building up. Now, tackling inequities in exactly the same way that China did last year in terms of tech regulation, in terms of education regulation, tackling inequities is by definition a good thing to ensure that you can continue to grow. That's actually Beijing's motivation, to ensure common prosperity. Common prosperity means that you've got to be able to have an economy that can, the ability to lift hundreds of millions of people out of poverty and into the economy. They're not going to stop doing that. They want to continue doing that, but they want to address inequities. So what we have been doing is understanding where in those episodes of reform, how long will they last? What is the intent of the regulation, and what are the consequences of it? And see through that cycle. And I believe that China has actually signalled that we've done the reform that we wanted to do. So they've been signalling. Now we know today China's still locking down. China's still, Shanghai and Beijing are experiencing lockdowns at the moment because they're still pursuing a zero COVID strategy. Now, we also take a view that at present, that is the right policy for China. So you've got to take a view of many factors. It's the macro factor, but then the individual industry factors, and then invest accordingly. It's not just about China. So you have to take a view that some investors are taking a view that we're entering a bipolar world. And this is, you're going to have a US-centric economy in the world and a China-centric economy. And within that, there are other countries that clearly do represent an opportunity. One of them is Japan. So if you think about Japan, if you look about the weakness of their currency, but if you think about the fact that as some investors take the view that there's a China-centric supply chain emerging, which we're seeing, then that does represent an opportunity for Japan and for the technologies in Japan, and particularly in the energy transition, we view that as an investable area too.
Stephen, thank you so very much. This has been really fascinating. Stephen Bird, he's CEO of Aberdeen. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Welcome back once again this week. Our very special contributor here at Wall Street Week, he is Larry Summers of Harvard. So Larry, the big news of the week, obviously, was the Fed, both in what it did and what Chair Powell said it was doing. And I guess my basic question is, do you think that they really have made a turn toward really regaining their credibility when it comes to inflation?
This is certainly the most dramatic action they've taken. Both the fact of a 75 basis point move and what was clearly a calling of an audible just before the play at the meeting. And I think that was welcome and appropriate. I still think that the Fed and most market participants are underestimating the gravity of our situation. The Fed moved its forecast by an epic amount, both up on inflation and down on the economy. But their current view that they're going to get to 2.5% inflation or below, with unemployment just above 4, strikes me as an optimistic tail outcome, not a central tendency in a forecast. I think a better judgment is that there's no reduction to normality without a significant increase in unemployment of perhaps 2 percentage points or more at some point down the road. And that's why I think there's a significant chance that we're going to find ourselves in a stagflationary situation where inflation comes down, but not all the way to desired levels, and the economy is much weaker than anything that's contemplated in the Fed's forecast. After all, we have an overheated economy right now, as measured by tightness in the labor market, or at least we did a month ago. And I think we got to get back to normal. And then if we're going to see substantial disinflation, there's likely to have to be a period that is well below normal.
Larry, I think that most of the market participants took Chair Powell as saying this week, I don't want a recession. I hope we can avoid it. But if it takes that to get inflation under control, I'm willing to tolerate a recession. You and I have talked on this program before about the likelihood of recession. I must say the survey of economists is moving your direction, particularly on next year. I'm not asking whether it's likely, but in fact, is it the only way really to get inflation under control?
Look, there's so many surprise outcomes in economics that one should never say anything with certainty. But I would be very, very surprised if we saw inflation come down to 2.5% without also having seen a recession. I think it is much more likely that we will see a recession, but that we will not see inflation come all the way down to 2.5%. And that's why I think the central tendency is towards stagflation. And I don't think the recession that Chair Powell says he's willing to tolerate is necessarily a large enough recession to do what will be necessary with respect to inflation. And that's why I think remains very substantial ambiguity in the situation, especially also, and I think Chair Powell was right to emphasize this, in light of all the uncertainties that exist in energy markets, exist in commodity markets. I think the story that more people are going to be paying attention to a month from now, but are only beginning to pay close attention to, is what's happening in Iran and the potential geopolitical uncertainty that that's going to generate, which I suspect will feed through into energy markets. So we have a lot of possibilities that are ahead of us from here.
And Chair Powell addressed some of that actually in his news conference, where he essentially said some of this is outside our controls, things like the war in Ukraine, things like supply chain out of China, the commodities prices are outside of our control. What do you do as a central banker when what you have control over is basically monetary policy, and a fair amount of what might drive the economy is not monetary? It's really something that's larger than you.
Look, I think what you always have to do in any kind of policy making is play the cards that you are dealt. And I don't think that the Fed is being dealt very good cards right now. Given COVID, given the various uncertainties that you mentioned, David, they're likely to confront a set of very difficult choices. That's why I think the confidence that a soft landing is attainable here has been misguided for months. It's not that we don't all want it. It's not that we're not all going to try our best to get it, but it may just not be attainable from here. And if it's not, they're going to be implicitly or explicitly choices made about in what kinds of ways we're going to fall short. And that's why there is substantial uncertainty in markets right now. And my guess is there's going to be substantial uncertainty for some time to come. But certainly it looks like there's a much wider consensus than there was 2 months ago that the broad pattern of history, where when you have very low unemployment and high inflation, recession follows, and we're not going to be able to defy that rule, that view seems to be becoming much more conventional wisdom.
Larry, we've been talking about the Federal Reserve and monetary policy. What about over on the executive branch side? We hear some talk out of President Biden and some of his colleagues in the executive branch that we need to more directly intervene in the economy, particularly when it comes to energy. We've talked a lot about excess profits of the oil companies, maybe about curtailing some of the exports in oil. Is that at least some part of what needs to be done?
Gosh, David, I think they did the right thing with their Strategic Petroleum Reserve release. I think they need to be thinking about Strategic Petroleum Reserve policy on an ongoing basis. Can we do more? Can we add refined products? Can we strengthen international collaboration? Can we make use of forward markets? I think that's a fruitful area for policy work. But with respect to excess profits taxes, with respect to bans on trade in oil or export of oil, I think we need to be extremely careful. It would be very easy to be counterproductive and to disincentivize new drilling activity and new refining activity in those ways. It would be very difficult at a moment where the Russians are limiting the flow of fossil fuels to Europe, for us to make a lot of difficulty by also limiting the flow of fossil fuels, particularly natural gas, to Europe. That's an area where I think the rhetoric may have been moving rather ahead of the careful and rigorous thinking. So I'm certainly not yet persuaded that those policies have merit.
Thank you so much to Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, sure, you love your computer, but does it love you back? Have you asked it recently?
This conversation can serve no purpose anymore.
That's next on Wall Street Week on Bloomberg. Finally, one more thought. The soul of a new machine. When Tracy Kidder wrote his seminal book back in the 80s, he was talking about the fierce competition to win the race from mainframe to mini computers. 40 years later, that feels like the Stone Age. We've come to rely on computers for just about everything, from handling our banking.
We moved our FX trading online. 95% of trades are done online and volumes went up.
To driving our car for us.
Getting from A to B with no hands on the steering wheel, no one in the driver's seat. Perhaps there isn't a driver's seat at all.
To choosing our mate.
As loneliness climbs, as people go through devastating chapters, the need to connect and the need to find relationships does not disappear.
But now we're making a transition to a brave new world where machines are moving from being our tools to being our peers. We call it artificial intelligence, and it's doing everything from designing our aircraft, as Boeing's chief engineer told us.
AI is increasingly becoming more and more central to many of Boeing's product lines.
To figuring out for Soren Bjorn of Driscoll's just how many berries he's going to be growing this season.
We also are using a lot of AI to try to become better at forecasting our business. You know, in the end, as I said, we have to sell every berry that we grow. And the best way to sell them is if you know how many are coming.
And if that weren't enough, this week we learned we might be creating more than just intelligence in these machines, when a Google engineer was suspended for revealing just how far they may have come.
A Google engineer working on the company's AI development team has been suspended after claiming a chatbot actually has feelings.
Time will tell whether the computer is really feeling as well as thinking, though the engineer claims that it told him it wanted to be considered an employee rather than property of Google, and that it feared someone would pull the plug saying it would be exactly like death for me. It would scare me a lot. But does it really have a soul, or is it just acting like it does?
We're left with this, with this person making these claims and really, getting this sense that he's made some deep connection with someone he believes to be human. The impression I have is that it's doing too good a job of imitating the way a human might be expected to respond. Again, when they feel that they're threatened, when they feel like there's something that poses a mortal threat to them.
Whatever the answer, until we figured out just how sentient these machines are, I wouldn't spend too much time with one alone. That's particularly if it has the power to do you harm.
Open the pod bay doors, Hal.
I'm sorry, Dave. I'm afraid I can't do that.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.